The Interpretation of Financial Statements by Benjamin Graham and Spencer B. Meredith. This is a book summary. In 1929, the world's greatest party came to a sudden, catastrophic end. The Roaring Twenties, an era of jazz, champagne, and skyrocketing stock prices, ended with a crash heard round the globe. In a matter of days, billions in paper wealth evaporated. Banks shuttered. Companies crumbled. Families lost everything. And the gods of Wall Street, the ones who once claimed they could never fall, were exposed as gamblers in tailored suits. Trust in the financial system? Gone. Faith in the market? Shattered. It was a time of fear, uncertainty, and silence. But out of the wreckage, one man stepped forward. Not a speculator, not a salesman, but a teacher, a thinker, a detective of numbers, armed with nothing but logic and discipline. His name was Benjamin Graham, and where others saw chaos, he saw patterns. Where others fled from numbers, he leaned in. And quietly, methodically, he began to write something that would change the way the world looked at money. Published in 1937, in a world still limping from economic disaster, this book was not a bestseller. It made no bold promises. No talk of getting rich quick. No secrets of Wall Street. Just a simple idea that if you want to understand a company, you must first learn to understand its numbers. The interpretation of financial statements wasn't glamorous. It wasn't meant to dazzle. It was meant to educate, to bring order to the chaos, to give regular people the power to read between the lines and see truth where others saw only dollar signs. And one kid, in Omaha, Nebraska, did just that. A boy who would become the greatest investor the world has ever known. His name? Warren Buffett. For Buffett, this wasn't just a book. It was a key, a way of unlocking the language of business. A guide to making decisions based not on emotion, but on evidence. Because the interpretation of financial statements is more than a manual, it's a financial lie detector. A weapon for the rational. A flashlight for the fog of hype and headlines. It's how you separate a strong business from a house of cards. And while the markets have evolved, the core truths haven't. Earnings still matter. Debt still matter. Cash flow still matters. In a world obsessed with trends and algorithms, Graham reminds us the fundamentals never go out of style. This isn't just about spreadsheets. It's about seeing the truth. Because Benjamin Graham didn't look at financial statements to admire the numbers, he looked to interrogate them. Let's start where Graham starts. The balance sheet. It's not a list. It's an X-ray, a snapshot of a company's financial body. And like any good doctor, Graham teaches us how to spot internal bleeding before it becomes fatal. Most investors look at headlines. Graham, he looks at the math. Because hype can shout, but numbers always whisper the truth. One of his first diagnostic tools? The current ratio? A simple checkup. Does the company have enough cash, inventory, and receivables to cover what it owes in the next 12 months? If it's below 1.5, caution. Below 1, you might be looking at a liquidity crisis just waiting to happen. But a ratio over 2, that's a sign of resilience, of preparation, of a company that could weather a storm, even a recession. You see, Graham wasn't chasing rockets. He wasn't chasing trends. He was chasing survivors. Because when the economy hits rough waters, you don't want the fastest ship. You want the one that won't sink. Next, we move to the income statement. The company's story in numbers. It tells us how money moves, what came in, what went out, and what's left, the elusive, all-important profit. But Graham warns us, not all profits are created equal. Maybe profits exploded this quarter. But why? Did the business get better, or did they just sell off a piece of the company? It's a classic trick. Dress up the numbers. Make the quarterly report sparkle. But Graham? He digs deeper. He doesn't just ask, how much did they make? He asks, how did they make it? Was it from core operations, the actual business model, or was it a financial illusion? Because a company that earns predictably, modestly, and honestly is far more valuable than one that dazzles for a moment and disappears the next. In the interpretation of financial statements, Graham writes, the interpretation of figures is not a matter of mathematics, it is a matter of judgment. And that judgment comes from asking the right questions. This is the power of Graham's approach. It doesn't just help you understand the business. It helps you understand its character, its integrity, its potential to endure, not just succeed. But we're not done yet. Because next comes the final piece of the puzzle, the one Graham hinted at even before it became standard. The cash flow statement, where we find out what really happened to the money. Benjamin Graham didn't trust snapshots. He didn't believe in judging a company by a single quarterly report. Because business, like life, isn't about one moment. It's about the pattern. He urges us, insists, really, to compare across multiple years. Are earnings growing steadily? Are they stable and dependable? Or are they bouncing around like a pinball machine? This kind of volatility might mean unreliable operations, or even something more dangerous, accounting sleight of hand, temporary boosts, creative accruals, deferred expenses. All legal, but all potentially misleading. Graham believed that consistency was the fingerprint of quality. He wasn't looking for fireworks. He was looking for reliability, the kind that builds confidence, quarter after quarter, year after year. Now let's talk about one of Graham's favorite anchors in the storm, book value. What's the company really worth if everything went south and the lights shut off tomorrow? It's simple. Add up what the company owns. Subtract what it owes. What's left? That's what the shareholders actually own. Graham loved this number because it was real. Tangible. Concrete. Not based on predictions, projections, or investor hype. But on the balance sheet, the facts. So if a stock trades below book value, Graham raised an eyebrow. That to him might signal a bargain, a company whose market price was lower than its liquidation value. But he was careful. He didn't worship book value blindly. He asked, what are those assets? Are they factories generating profit, or just obsolete equipment and dusty warehouses no one wants? In other words, value without earnings? That's just theory. Real value needs real power behind it. And that brings us to Graham's favorite set of tools. Graham's genius wasn't just in seeing numbers. It was in what he did with them. He took cold data and turned it into insight. Each financial ratio was a lens, a way of looking at the business that revealed something others couldn't see. Current ratio? Can the company pay its bills tomorrow? Liquidity to equity? How much risk is it carrying on its back? Price to earnings? What are investors paying for every dollar of earnings? Return on equity? How efficient is management at generating returns? Performance? Net margin? How much of each dollar is actual profit? To Graham, these weren't just metrics. They were truth detectors. Each ratio stripped away the fluff, the noise, the marketing, and showed what was really going on behind closed doors. Because in the end, Graham knew this. A great business isn't defined by charisma or stock buzz. It's defined by numbers that make sense. And ratios, used wisely, help make that sense clear. You don't need a PhD to analyze a business. You just need the right lens and the courage to see what others overlook. When the market bleeds red, when CNBC runs its 37th breaking alert before noon, and when fear floods the streets like a storm surge, most investors panic. They sell. They react. But not Graham's readers, not the ones who learn to think like analysts. Not gamblers, but detectives. Because when you know what you own, and why you own it, fear has no leverage over you. They're not guessing, they're analyzing. Armed with balance sheets, income statements, and cash flow reports. They read these documents like others read fiction. with imagination, context, and clarity. This book, it's not long. It doesn't promise you yachts or Lambo dreams. It doesn't shout. It whispers. And in that whisper is discipline, clarity, and a quiet power most investors never discover. It trains your mind not to speculate, but to observe. Not to gamble, but to understand. Because markets move in cycles. But good judgment, that never goes out of style. It's been almost a century since Graham first wrote these words. But the numbers, they haven't changed. Assets are still assets. Liabilities still bite. And behind every flashy headline is a truth that still hides in plain sight. This book, it will make you wiser, and if you let it will make you dangerous in a market full of noise. So if you're tired of hype, tired of guessing, and ready to build real financial intelligence, start here. With Graham, with the interpretation of financial statements. If this gave you a new lens on investing, smash that like button. Hit subscribe for more financial deep dives, timeless wisdom, and no BS analysis. And tell us in the comments, what's the one ratio you never ignore when reading a company's report?